Module Overview. Introduction to Group Financial Reporting. In a business group with a parent company and subsidiaries, consolidated financial statements are prepared to present the entire group as a single economic entity. Consolidated financial statements combine assets, liabilities, equity, income, expenses of the parent and its subsidiaries. This provides a clearer picture to investors, regulators, and creditors by showing the true scale and performance of the entire group. Key entities in group reporting. In today's teaching, we will be using entity type and definition in our table. 1. Parent A company that controls one or more subsidiaries. 2. Subsidiary A company that is more than 50% owned or controlled by another company. 3. Associate an entity where the parent holds 20 to 50% of voting power, significant influence. 4. Joint venture. A jointly controlled entity under a contractual agreement. Why prepare consolidated financial statements? To provide a true and fair view of the financial performance of the group. To eliminate double counting of intercompany transactions. To comply with accounting standards, e.g., IFRS 10, IAS 27. For transparency and comparability. To show the economic reality, not just legal separateness. Steps in consolidation process. Combine like items of assets, liabilities, equity, income and expenses across all entities, eliminate intercompany. Transactions, sales, receivables, payables, etc. Eliminate intercompany shareholdings. Parent's investment in subsidiary versus subsidiary's equity. Calculate goodwill or gain on bargain purchase. Recognize non-controlling interest, NCI. Apply uniform accounting policies across all entities. Align the reporting periods, same year-end. Understanding goodwill and non-controlling interest, NCI, goodwill. The excess of purchase price over the fair value of the net assets acquired. Goodwill is tested for impairment annually. Non-controlling interest, NCI. Portion of equity in a subsidiary not attributable to the parent. 2 methods to measure. Proportionate share of net assets, fair value method. Eliminating intercompany transactions. These transactions must be eliminated because they do not represent external activity. In this course, we will be using example and adjustment in our table. 1. Sales from parent to subsidiary. Eliminate both sales revenue and cost of goods sold. 2. Intercompany loan remove, receivable and payable, unrealized profit on inventory. Adjust inventory and profit. 3. Dividends from subsidiary to parent. Eliminate dividend income. Challenges in group reporting. Different currencies, requiring translation. Complex ownership structures. Changes in ownership interest. Loss of control and disposal of subsidiaries. Partial acquisitions. Diverse accounting systems. Benefits of consolidated reporting. Better understanding of overall performance, consolidated risk and exposure insights, easier comparison across time and industry. Strategic decision-making based on holistic data. Illustrative example. Assume parent owns 80% of subsidiary net assets, Barks N100 million. Purchase price, Archte N120 million. Goodwill, Arch N120 million. 80% X M100 million. Arch N40 million. NCI, Arch N 20% X M100 million, Arch N 20 million. Key standards governing consolidation: IFRS 10, Consolidated Financial Statements, IFRS 3, Business Combinations, IAS 28, Investments in Associates and Joint Ventures, IFRS 12, Disclosure of Interests in Other Entities. Summary of key takeaways. Consolidation presents a group of entities as one business unit. It eliminates internal transactions and reflects only external financial realities. Goodwill and NCI are crucial components. Compliance with IFRS and strong internal systems is necessary. Consolidated financials are essential for strategic decision-making and investor confidence.